Ray Dalio's portfolio survived the 2008 crash with only a 6% drop while everyone else lost 30%. Here's exactly what's inside it. The billionaire founder of Bridgewater Associates built something called the All Weather Portfolio back in 1996. This thing is designed to make money whether the economy is booming or crashing, whether there's high inflation or deflation happening. Most people have no idea how to protect their money when markets go crazy. They panic sell at the bottom or miss the recovery entirely. The all-weather portfolio uses a completely different approach than what most investors do. Instead of trying to predict what's coming next in the economy, it prepares for everything at once. Think about it like this. If someone asked what the weather would be like next year, nobody could tell them with certainty. Would it be sunny, rainy, snowy? The smart move is not trying to guess, but preparing for all possibilities. That's exactly the philosophy here. This portfolio balances 5 different types of assets that react differently to economic changes. When one asset struggles, another one typically does well, creating a natural protection system. The entire strategy is built on something called risk parity, which means balancing the risk across all holdings instead of just splitting up the money equally. Before we dive into each asset, understanding why this matters is critical. Traditional portfolios typically put 60% in stocks and 40% in bonds. Sounds balanced, right? Wrong. Because stocks are so much more volatile than bonds, that 60-40 split actually means about 90% of the risk comes from stocks. When markets crash, these portfolios get destroyed because all the risk is concentrated in one place. The all-weather approach flips this completely. It spreads risk evenly across different economic scenarios. Ray Dalio and his team identified 4 main economic environments that drive all market returns: rising growth, rising inflation, and falling inflation. Each of the 5 assets in this portfolio performs well in at least one of these scenarios. Now let's break down exactly what these 5 assets are and why each one has a specific job in the portfolio. Number 1. Stocks. Stocks make up 30% of the all-weather portfolio. Wait, only 30%? Most people put way more than that in stocks. That's the point. This portfolio deliberately limits stock exposure to control volatility. Stocks do one job really well. They grow when the economy expands. When companies make more profit, stock prices go up. When GDP increases and businesses thrive, shareholders win. The problem is, stocks also crash hard during recessions. They're incredibly sensitive to economic contractions. By capping stocks at 30% instead of the traditional 60%, the portfolio reduces massive swings in value. During good times, this means giving up some gains compared to stock-heavy portfolios. But during crashes, it means avoiding devastating losses that can take years to recover from. The stock portion typically uses broad market index funds like the S&P 500. This gives exposure to large established companies across different industries. Some versions also include a small allocation to emerging markets for additional diversification, but the core remains U.S. large-cap stocks. During the 2008 financial crisis, the stock market dropped about 50% from peak to bottom. Portfolios heavily concentrated in stocks got destroyed. People saw their retirement accounts cut in half. Many panicked and sold at the worst possible time, locking in permanent losses. The all-weather portfolio, with only 30% in stocks, experienced a much smaller drawdown of around 20%. That difference is massive when thinking about real money and real lives. Number 2. Long-term bonds. Long-term bonds represent the single largest holding at 40% of the portfolio. This surprises most people. 40% in bonds that mature in 20 or 30 years? That seems excessive, especially for younger investors. But there's a specific reason for this heavy allocation. Long-term bonds serve as the primary defense against economic contractions and deflation. When the economy slows down or enters recession, central banks typically cut interest rates to stimulate growth. When interest rates fall, existing bonds with higher rates become more valuable. Their prices go up significantly. This creates a perfect counterbalance to stocks. When stocks crash during recessions, long-term bonds usually surge in value. They're like an insurance policy that pays out exactly when needed most. The longer the maturity of the bond, the more sensitive it is to interest rate changes, which means bigger price movements that can offset stock losses. Think about what happened during the 2008 crisis. While stocks were collapsing, long-term Treasury bonds rallied hard. Investors fled to safety, and U.S. government bonds are considered the safest assets on the planet. People who held significant allocations to long-term bonds saw those holdings increase in value right when their stocks were dropping. The same thing occurred during the COVID-19 crash in March 2020. Stocks fell 30% in just a few weeks. Long-term bonds jumped as the Federal Reserve slashed interest rates to zero. Once again, this asset class provided crucial protection when it mattered most. The 40% allocation might seem conservative, but it's calculated based on risk, not just returns. Long-term bonds are less volatile than stocks, so allocating more to them on a dollar basis actually creates equal risk exposure across the portfolio. This is the essence of risk parity, equalizing risk contribution rather than just splitting capital evenly. Number 3. Intermediate term bonds. Intermediate term bonds make up 15% of the portfolio. These are bonds that mature in 7 to 10 years, sitting right in the middle between short-term and long-term bonds. Why have both long-term and intermediate bonds? Aren't they basically the same thing? Not exactly. Intermediate bonds provide a cushion and diversification even within fixed income. They're less sensitive to interest rate changes than long-term bonds, which means they're more stable but provide less dramatic protection. During periods of rising interest rates, long-term bonds can actually lose value because their fixed payments become less attractive compared to new bonds issued at higher rates. Intermediate bonds suffer less in these situations because they mature sooner, allowing reinvestment at new rates faster. This portion of the bond allocation adds stability without sacrificing too much upside during deflationary periods. It's like having a backup to the backup. If long-term bonds get hit by unexpected rate increases, intermediate bonds won't drop as severely. The split between long and intermediate bonds creates a bond ladder effect. Some bonds are more sensitive to rates, others less so. This provides protection across different interest rate environments. Whether rates are rising, falling, or staying flat, the combined bond holdings should perform reasonably well. Intermediate bonds also generate steady income through interest payments. While total returns might not match stocks over decades, the reliable income stream adds value and reduces overall portfolio volatility. For retirees or anyone needing regular cash flow, this characteristic is particularly valuable. Together, long-term and intermediate bonds make up 55% of the total portfolio. More than half the allocation goes to fixed income. This seems crazy to young investors who've been told to be aggressive with stocks. But remember, this isn't about maximizing returns in bull markets. It's about surviving all markets, including the ones that destroy unprepared portfolios. Number 4. Gold. Gold represents 7.5% of the all-weather portfolio. This precious metal serves a very specific purpose: protection against inflation and currency devaluation. When inflation rises, the purchasing power of money decreases. A dollar buys less than it did before. During these periods, physical assets like gold tend to maintain or increase value because they can't be printed or created out of thin air like currency. Throughout history, gold has acted as a store of value during times of economic uncertainty. When people lose faith in paper money or government stability, they flock to gold. When inflation spikes and erodes savings, gold provides a hedge. It's been valued for thousands of years across every civilization and culture. During the 1970s, the U.S. experienced severe stagflation, high inflation combined with slow economic growth. Stocks struggled badly. Bonds got crushed because rising inflation meant rising interest rates, which tanked bond prices. Gold absolutely soared during this period, increasing more than tenfold throughout the decade. More recently, Gold has performed well during times of monetary expansion and negative real interest rates. When central banks print massive amounts of money and interest rates are lower than inflation, gold becomes attractive because it preserves purchasing power better than cash or bonds. The 7.5% allocation provides meaningful exposure without overcommitting. Gold doesn't generate any income, no dividends, no interest payments. It just sits there hoping to appreciate. Too much gold would drag down total returns during normal economic periods when stocks and bonds perform well. But having some provides crucial insurance. Gold also has low correlation with stocks and bonds, meaning it often moves independently of them. This diversification benefit is valuable. When both stocks and bonds are struggling simultaneously, which can happen during stagflation, gold often thrives. Some investors question whether gold is necessary at all. After all, it's had long periods of poor performance. From 1980 to 2000, gold went essentially nowhere while stocks boomed. But that's precisely why it belongs in an all-weather portfolio. Those 2 decades represented a period of low inflation and strong economic growth, an environment where gold naturally underperforms. The portfolio doesn't need gold to excel during those times. It needs gold for the opposite scenario. Number 5. Commodities. The final 7.5% goes to commodities. This includes raw materials like oil, copper, agriculture products, natural gas, and other physical goods that economies need to function. Commodities serve a similar role to gold, but with broader exposure. They protect against inflation because when prices rise across the economy, commodity prices usually rise as well. These are the actual physical things that make up the inflation calculations: energy to power businesses, metals for construction, crops for food. Unlike gold, many commodities also benefit from economic growth. When the economy expands and companies build more factories, they need more copper and steel. When people drive more, they need more oil. When populations grow, they need more agricultural products. So commodities can perform well in rising growth environments, not just inflationary ones. This creates overlap with stocks in some scenarios, but provides crucial differentiation in others. During periods of rapid economic expansion with rising inflation, think the early 2000s or certain emerging market booms, commodities can outperform both stocks and bonds significantly. The challenge with commodities is they can be extremely volatile. Oil prices can swing wildly based on geopolitical events, supply decisions, or demand shocks. Agricultural products depend on weather and growing seasons. This volatility is why the allocation is kept small at 7.5%, enough to matter, not enough to dominate. Commodities also have negative correlation with bonds during certain periods. When inflation rises and bond prices fall, commodity prices often increase. This provides another layer of diversification that helps stabilize the portfolio across different environments. Some implementations use commodity-focused funds or ETFs that track broad commodity indices. Others might use inflation-protected securities or real assets as a substitute. The exact vehicle matters less than the exposure to the underlying asset class. Together with gold, commodities make up 15% of the portfolio dedicated to hard assets. These tangible physical things provide ballast when paper assets struggle. They've preserved wealth through wars, depressions, currency collapses, and every other economic disaster in history. Here's what makes this portfolio actually work in real life: rebalancing. Without this crucial step, the entire strategy falls apart. Over time, different assets grow at different rates. If stocks have a great year, they might grow from 30% to 40% of the portfolio. Bonds might shrink from 55% to 45%. The portfolio is now out of balance and no longer provides the risk protection it was designed for. Rebalancing means selling assets that have grown too large and buying assets that have shrunk too small, bringing everything back to the target allocations. This forces a disciplined approach of selling high and buying low, which is exactly the opposite of what most investors do emotionally. The frequency of rebalancing matters. Research on this specific portfolio suggests quarterly or annual rebalancing works well. More frequent rebalancing might generate excessive trading costs and taxes. Less frequent rebalancing allows the portfolio to drift too far from its targets. During major market movements, rebalancing becomes even more critical and more difficult emotionally. In 2008, when stocks crashed, the disciplined investor would have sold some of their bonds, which had increased in value, to buy more stocks at depressed prices. This felt terrible at the time because stocks were still falling and might fall further. But it's exactly what the strategy requires. The same thing happened in reverse during 2020 and 2021. Stocks soared to extreme valuations. Bonds underperformed. The correct move was selling some of those expensive stocks to buy more bonds, even though it felt like missing out on continued stock gains. The all-weather portfolio's track record speaks for itself. From 1996 to 2020, it generated average annual returns around 9 to 10%, with significantly lower volatility than stock-heavy portfolios. During the 2008 financial crisis, it dropped only around 20%, while the stock market fell 50%. During the COVID crash, it fell just 6%, while stocks dropped 30%. These aren't the highest possible returns. Someone who invested everything in stocks during the 2010s bull market would have crushed these numbers. But that same person would have been destroyed in 2000, 2002, and 2008. The all-weather approach trades some upside potential for downside protection and consistency. This makes it particularly valuable for people who can't afford major losses. Retirees living off their portfolios, people close to retirement, or anyone who loses sleep over market volatility. It's also valuable for people who know they'll panic and sell during crashes. The portfolio's stability helps investors stay the course. The 5 assets work together like instruments in an orchestra. Each has a specific role. Stocks provide growth. Long-term bonds protect against deflation and recession. Intermediate bonds add stability. Gold hedges inflation and uncertainty. Commodities protect against rising prices and benefit from growth. No single asset needs to perform perfectly because they cover different scenarios. Building this portfolio is straightforward using low-cost index funds or ETFs. Total costs can be kept under 0.2% annually, which is remarkably cheap for the diversification provided. Many platforms allow automatic rebalancing, removing the emotional difficulty of the process. The psychology behind this strategy is just as important as the mechanics. It removes the need to predict the future. It eliminates the temptation to time the market. It provides a clear, rules-based approach that works regardless of headlines or fear or greed. Ray Dalio created this for his own family trust. He wanted something that would work after he was gone, when nobody would be actively managing it or making predictions. That's the ultimate test of a strategy. Would it work on autopilot for decades without any genius making calls? The answer appears to be yes. The principles of diversification across economic environments, risk parity allocation, and disciplined rebalancing create a portfolio that genuinely works in all weather conditions. Not perfectly, not with the highest returns, but with consistent performance and protection when markets turn ugly. For anyone tired of losing sleep over market crashes or wondering if their portfolio can survive the next recession, the all-weather portfolio offers a proven alternative worth considering. Subscribe if this was helpful.